Hey, this is Skyler with Regan. Let's give a quick update as we have a huge number coming out tomorrow, US CPI, and what we think the market is missing. And we could see a big surprise to the downside in terms of bonds tomorrow. So if we look at CPI year over year, it's actually scheduled to go up tomorrow. So last month we had about a 10 basis point move. We're expected to have about a 30 basis point move. And remember, this is July 14th. The data will be released tomorrow, July 15th. This is June numbers. Okay. So we're expecting, the market's expecting CPI to go from 2.4 to 2.6, getting dangerously closer to 3%. Now let's pull up what that means. We've done a lot of work on this data, and we created these charts for ourselves to say, okay, May CPI was 238. What if CPI stays and doesn't grow at all month over month, zero point 0.0? We're still going to see another 2.38 because this relies on the last 12 months. But if we get that zero point 0.3 number, that CPI will go from 238 up to about 270. And if we have another zero point 0.3 for July that'll get reported in August, we'll get up to 2.9. You can kind of see the trend here. And this is all seasonally adjusted. And you can see the trend here. If it's zero point 0.2, we're going to stay stubbornly high for a while. Okay. And remember, the two Fed mandates are A, keeping prices intact or controlled. Their magic number is about 2. B, employment, keeping full employment. Let's look at employment numbers right here. And you had this huge spike during COVID. You had this move from the GFC, which was 10%, all the way down to pre COVID numbers of about 360. It didn't take us long to get back to that 360. And it was only 2 weeks ago that we reported the previous month jobs numbers. Unemployment rate was expected to go to 430, 430 or 440, and it came down to 4.1. At 4.1%. We see here 4.17. So just looking at the data, ignoring the noise, you would expect the next move and people talking about the Fed actually hiking. When and if they're going to hike, whether it's July, September, or sometime later in the fourth quarter. Ignore the noise, look at the numbers, look at what's going to happen tomorrow, and think about how that might affect fixed income and how that might affect interest rates. We have this weird curve right now that's showing or anticipating upwards of about 4 Fed hikes in the next year. Okay. If that doesn't happen and the Fed doesn't drop rates, I meant the Fed dropping 4 times in the next year, we should see some significant sell off in the belly and in the back end of the curve, which means for investors, we want to stay short, stay floating rate, and wait out. Either if that bad news does come, don't you want to be on the front end of the curve, okay, up here? And let's look back to when the Fed did cut last fall, September 18th. This is the day before that. What actually benefited the most was this part of the curve because that part of the curve dropped the most, whereas this part of the curve actually went up. And we should expect a repeat of that if the Fed were to cut, if the Trump were to bring in a new Fed chair and he magically cuts a point tomorrow and he goes from here to here, I would actually expect the back end to go up a bunch. Okay, so you're not going to get rewarded owning duration, but be mindful of this print tomorrow that the market is expecting inflation to go up and to actually have 2, 3, 4 bad prints in a row, which should totally quash the idea of the Fed cutting rates anytime soon. Thanks.